So the next one is the world economy. So when I talk about the world economy, I wrote, if the world economy is growing rapidly, demand for exports is likely to increase. This in turn should lead to a rise in domestic investment. However, a worldwide recession would reduce the demand for exports. Exporting firms are likely to reduce their investment as a result. So the world economy simply means what is happening within the world. If the world economy is increasing, is growing rapidly, it means demand within the world would increase. Export would increase. So exporting firms would rather increase their investment. These are domestic firms. They will increase their investment because demand for their goods will increase. But if the world economy is in recession, the aggregate demand would fall. Demand for export would fall. Exporting firms would not have any other option or choice than to reduce their investment. Is it clear?
Yes.
Any question about that?
No.
Good. The next one is availability of credit. For availability of credit, I wrote, some investment is financed through borrowing. So the amount of money that is available for borrowing within the financial system will determine the level of investment through borrowing. So the more banks consider firms as too risky, the less the money available to them, therefore impacting on the level of investment. So availability of credit facilitation comes from the financial institutions. So if financial institutions figure out that firms are high risk of a customer, they would not give them loans, which means investment through borrowing would reduce. But if firms figure out that if banks figure out that, or financial institutions figure out that banks are low risk of a customer, they would make credit available to them, then investment would increase. So if credit facility or facilitation is increasing, investment would increase. If credit facilitation is reducing, investment would reduce. Is it clear?
Yes, sir.
Any question about that?
No, sir.
The next one is retained profit. For retained profit, I wrote, it helps to determine the level of investment. If retained profit is low, firms won't be willing to invest as they don't have assurance that the new investment will generate more profit than the previous. So mostly, since corporate tax has to be paid from profit, it can logically be said that a lower tax rate may increase the profit available to firms, allowing more retained profit to be used for investments. So the point is this. For retained profit, it determines the amount of money available for firms to use for investment. So if firms figure out that the retained profit is low, they would not have that, confidence to invest that retained profit into capital goods, because they are not assured what happens in the future. So if they are making if they have a low retained profit now, why do they have to risk it again to invest in capital goods? They don't have assurance, so they might not want to invest. But then we have to think about retained profit, which comes after taxes has been reduced. If after taxes have been paid. So if there's a low tax rate, then the retained profit will be higher. Then firms might be willing to invest more in capital goods. So a cut in tax rate, especially corporation tax, might increase investment. Is it clear? The next one, which is the last one, is the influence of governments and regulations. Government can use what we call fiscal policy. And when we talk about fiscal policy, we're talking about expansionary fiscal policy, which is taxes, reducing taxes and increasing subsidy. This might increase investment. So if government wants to increase investment within the economy, government might increase its spending, which allows firms to have a reduced cost of production. Or government might cut taxes, corporate taxes. If government is able to cut corporate taxes, firms will be able to make their cost of production would fall. They might invest more. That is fiscal policy. I think it's clear. Then we have regulations. So another way government can encourage investment is through guaranteeing loans. And when we talk about guaranteeing loans, it means government stands for firms that wants to borrow money from the bank. So in case the firms are unable to pay back, government will pay back. So we call it guaranteeing loans. So government stands as the guarantor for firms that wants to borrow money from the bank. So if banks are unable to retrieve their money from the firms, government will pay back. That's another way investment can increase. Do you get it?
Yes.
And sometimes government also use tax relief. Government allows firms to invest and they ensure that whatever tax they want to pay, it has to be offset from the investment. Clear? And for regulations, government can also use regulation. Regulations can directly prevent firms from investment. So this means, regulations can also directly prevent a firm from investing in a project because it is not permitted by regulations. So if regulations might not permit firms to invest, and if government wants to encourage investment, government might use deregulation. That means government soften laws, regulations that stop firms, that encourages firms. So if a country has a tough regulation, it might discourage investors, and that reduces investment. That ends investment. Any question about it?
No.